Good morning, everyone. I'm AJ Dasani from Ace Accountants and Merkle Sharp Accountants. And the next in our series of Meet the Experts is Andrew Bailey from Turpin Barker Armstrong. They're a larger accountancy firm based in Sutton as well. And we refer a fair bit to Andrew because he is the partner that deals with insolvencies, liquidation, etc. And I guess with sort of where the world is going right now, there's so many myths, there's so much stuff we read online. I thought we'd get an expert in to deal with this and the person that we refer to. So, Andrew, thank you so much for joining us this morning. How are you, sir?
I'm very good. Yeah, pleasure to be here. No, thanks very much for inviting me. So,
An
happy
pleasure.
to see what questions get raised and see what comes up.
I think it's just mainly what we'll do is we'll start off, I hope, with sort of two of the obvious questions that kind of come up, and then maybe in next week or next couple of weeks delve into a bit more detail. So the first one really is liquidation. We hear this a lot. What is liquidation? Loads of different types. Maybe give us the most relevant ones for SMEs and what they mean.
Yeah, absolutely. Yeah, so I think you can read a lot about it online. It gets quite confusing, doesn't it? Lots of different terms for different types of insolvency procedures, but liquidation is probably the one that comes up the most. And they're the higher numbers at the moment in terms of liquidation. So in a way, they're more of a sort of end of or a terminal event for a company. So there's really three different types. So there's a solvent liquidation. So this is also referred to as members voluntary liquidation. So when I talk about solvency, so this would be a company, often it would be where, let's say, an owner is looking to retire from a business and extract the value from that business. And so when I talk about solvency, it will be where a company's its assets are more than its liabilities. So they're looking to extract that money that might
solvent's
be
a good one.
Okay. Yeah, so that's the good one. So there's money there for an owner to extract. The insolvent, so this is when I say insolvent, that's where the liabilities of a company will be more than its assets, or for example, a company that can't pay its liabilities as they fall due. There's two types of insolvent liquidation. So there's a compulsory liquidation, which is also referred to as winding up a court. So that's a court-driven process. It's more commonly used by creditors. So if you're owed money and another company's not paying you, you would go to court to petition to wind up that company at court. So it's kind of, in a way, quite an aggressive course of action.
These are the ones that you hear of with HMRC, with football clubs and stuff quite often, isn't it? Is that right, the HMRC?
Absolutely.
Okay.
Yeah. So when you hear about HMRC have served a petition to wind up a company, that is what they're doing. So normally, using HMRC as an example, they would write to a company and say, look, you've got arrears of tax you need to pay up. It will then go through various stages within the HMRC teams, end up with enforcement and insolvency, and they will petition to wind up the company. So file a petition at court, that will be heard at court, and on that, at the date of that hearing, the judge might just say, look, I'm going to make a winding up order, and at that time, company is then in compulsory liquidation. The more common route for directors is something called a creditor's voluntary liquidation, and that is where a director is kind of making that decision to say, look, I recognise the company's insolvent and I'm going to put it into liquidation. So that's the more common route compared to compulsory, because a compulsory liquidation generally is a little bit slower because it's a court-driven route.
Because it's court-driven. Fair enough. And do any of these affect being a director in future?
So, yeah, as a director, you're not automatically just disqualified from acting as a director just because your company goes into liquidation. So I'm sure you'll probably have clients that they might be a director of multiple companies, and it might be the one or two, or some of their companies have to go through liquidation for whatever reason. So usually there's factors that lead to a liquidation of any company, and it's not always the director's fault because a company's gone into liquidation. So, but what I would say is, in terms of any insolvent liquidation, the liquidator has to look at the conduct of the director and the affairs of the company and what's caused the demise of that company.
And obviously, if they feel like there's anything untoward, that potentially they can disqualify that.
Absolutely, yeah. So it could lead to disqualification in just the worst case scenarios.
Okay. Let's contrast that then, I guess, to the other sort of words you hear a lot of is bankruptcy. So where does that kind of come into it, and how does that fit in? Just kind of give us a bit of a layman's guide.
Yeah. So bankruptcy, a lot of the time, so in the UK, it's still thrown into the mix of, look, a company's gone bankrupt.
Mm.
Whereas when you look at the proper definitions, it will be the bankruptcy relates to an individual. So it will be, so let's say if I compared it to, we were just talking about a company getting wound up at court.
Mm-hmm.
So in a way, bankruptcy is similar to that process, where if a creditor is owed money by an individual, they may well end up petitioning to bankrupt that individual. But equally, an individual could say, look, I recognise that I'm insolvent. I'm going to make myself bankrupt as well, because my liabilities exceed my assets.
So they are literally quite similar in terms of corollaries. Sort of liquidation is the company version, and then the bankruptcy is sort of the personal version, and then there's sort of a voluntary and an involuntary one of either one of both. So on that point, actually, just a final point, I guess, for this morning, is how does that affect, like, say, if you're a homeowner and you're looking at bankruptcy because things aren't going so well, are you necessarily going to lose your house? How does that generally tend to work out in practice and I guess in theory?
Yeah, absolutely. So with a property, I often get asked this by directors, will just be automatically, am I going to lose my house? Which is, I think the answer is just, look, no, just, understand, let's look at the process and what are the potential repercussions. If you go bankrupt and you've got a property, let's say a property has got a lot of equity sitting in that property, once you've gone bankrupt, your trustee in bankruptcy, which is really the person that's looking at your affairs and looking at your assets, will be saying, look, I need to realise your assets in order to pay your creditors. And they will look at the position with your property. Is there money sitting in that property? And the first step for a trustee is to come to the bankrupt and say, look, you've got some value in your property, and I need to realise that for the benefit of your creditors. Let's talk about it and come up with a strategy for trying to realise that value. So it's always important to cooperate with your trustee in bankruptcy who's looking at your affairs. In the worst case scenarios, where you've got a bankrupt individual that's not cooperating, that's when a trustee has to go through the process of that. I need to go to court to try and take possession of your property. But it's always the worst case scenario. You don't want to go down that process. Yeah,
that makes sense. Thank you so much, Andrew. I think I tend to try and call these a day at about 3 or 4 minutes, only because it's nice to keep them short and snappy. And I think we'll delve into a little bit more detail next week. And also, if you're watching this, firstly, thank you so much for watching it. But if you have any questions on the back of this or anything that we've not covered, feel free to let us know, because we'll be doing this as a little bit of a series to hopefully kind of debunk a lot of the myths and avoid you having to go onto Google and having sort of information from someone who isn't a licensed insolvency practitioner, which Andrew and I guess a lot of his team are. So thank you so much, Andrew. We look forward to continuing this in the next week or so. So that's been Andrew Bailey from Turpin Barker Armstrong. I'm AJ Dasani from Ace Accountants and Merck Sharp Accountants. And thank you so much for watching. All the details, as always, are going to be sort of tagged at the bottom in terms of TBA and us as well. And like I said, any questions, let us know. Have a lovely day, and obviously do take care. And if obviously you're worried about any of these things, Andrew's contact details will be on there. You're more than welcome to contact him for confidential advice as well. And obviously everything stays within that room. So thank you so much. Take care. Have a lovely day.